Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we break down the major themes and events driving currency markets this week and in the week ahead. Today I'm joined by Paul Robson and Brian Daingerfield, who are two co-heads of G10 FX strategy. Brian, I have to start with you because, even though we had a ceasefire agreement when it came to the Middle East conflict and we had talks, somehow we ended up with a double blockade of the Strait of Hormuz. How are you seeing developments in the Middle East and how is it affecting your currency space?
Yeah, thanks very much for having me, Eimear. So, it's been there's been a lot has happened, since we last recorded a few weeks ago. With the obvious one being, as you mentioned, the 2-week ceasefire between the U.S. and Iran, and various evidence of high level tensions between the two sides, but no major escalations to the point where that fragile ceasefire has broken down. And in FX markets, what we've seen is the dollar has reversed the entirety or most of, if not the entirety of its rise over the month of March during the Iran war. And so the markets have been very eager and willing to price towards, I think, a future where de-escalation is more likely than escalation, with the start of the 2-week ceasefire maybe being seen by some in the market as the moment when the Trump administration has effectively blinked here, worried about high energy prices, what it means for domestic political pressures as we head towards a midterm cycle in November. And I think the way that asset markets have taken this has been in a very positive way to reflect maybe this belief that the worst of the acute phase is behind us and that maybe the risk of prolonged severe escalation has maybe been reduced here, because neither side appears, regardless of what they say in sort of the front of house, that maybe there's a desire here to not allow the ceasefire to break. I think as I look at FX markets, positioning clearly matters. It's mattered in the run-up in the dollar and it's mattered in the pullback. And as we look at dollar positioning from the evidence we have, whether it be anecdotal or in positioning data from sources like CFTC futures positions, you get the sense that the market came into the month of March when the war started quite short of dollars, whether that be, especially I feel like in your space, Eimear, and emerging markets, but also in G10 as well. We ourselves had medium-term dollar shorts on. And I think that reflected a couple of things. First was a very low volatility environment. Market sense that productivity gains coming from AI adjustments are going to allow for non-inflationary growth in a lot of economies, that the Fed was going to be able to ease interest rates under new leadership in the back half of the year because services inflation was cooperating and goods inflation, while influenced by tariffs, was not going to be suddenly upended by a big spike in oil prices. And so I think the market on the positioning side was quite short of dollars. Throughout the beginning of the war, we flipped to, I think, if anything, a neutral or a modestly long position in dollars. And now that we've had a ceasefire, you've seen some reversion of that. I think as we speak to clients and we speak to accounts, my sense is that positioning in FX is broadly very light. And I think that's consistent with where we are in markets, because if you look at the dollar index range in 2026 so far, we're effectively at the middle of the range here. So it's not like the dollar is giving a strong sense that the market is very strongly positioned one way or the other. We are effectively mid-range in the dollar. I'll make one last point, is that the way the markets are sort of looking forward, I think, away from potential future escalations. Number one, that can be challenged by the possibility of future escalations, right? That there's nothing that really stops either side from breaching the ceasefire. The ceasefire could break down. All of that is still a possible risk. But the other thing is that while the dollar is back to levels it was before the start of the war, when you look at DXY terms, a lot of the longer term repercussions have not reversed. So, for example, energy prices are still meaningfully higher than they were at the start of the war. Expectations for fiscal policy, fiscal spending to counter those higher energy prices, those remain elevated and are likely to remain so. Some of the adjustments in expectations for central bank policy, a lot of hawkish repricing of central banks, including the Fed, has largely remained in place, even though the dollar has moved back to levels it was before the start of the crisis. And so, one of the things that we talked about in this space a few weeks ago was trying to think about what pieces of what themes that prevailed before the war can return if we get, say, an extension of the ceasefire or maybe a move towards a more durable peace. Which parts of the pre-war narrative, which I think was quite negative for the dollar, can return versus what struggles to come back because energy prices are still elevated. The Strait of Hormuz is still closed. In Asia, there are still, I think, signs of shortages of oil because they are unable to get supplies from the region, right? And so I think that's the big question here is that markets seem more than willing to price towards a better scenario in the future. But that eventually has to run into a reality where some of the features of the pre-war environment just are not back to the pre-war normal, and those things were a critical part in that broader environment for the dollar, which was negative. And so, very difficult to have a strong bias one way or the other for the dollar here, basically sitting at mid-range. And I think important to think about some of those repercussions of what can come back if the peace extends or the ceasefire extends versus what repercussions here maybe are more durable as drivers of FX markets.
Yeah, really interesting point about that discrepancy in the market reaction. Paul, I've got to bring you in here because Europe certainly is not, insulated from this conflict. How are you seeing the Middle East conflict from a European perspective?
Yeah, I think Brian went through it very well. It feels like markets want to believe that this is the beginning of the end of the crisis. And I think for European currencies, particularly euro dollar, it still remains the sort of dollar side of euro dollar, which I think is important. And Brian there just mentioning importantly pre-war themes and which ones come to dominate. And obviously, there's quite a lot of focus on the long-term structural trend in the dollar. And from my side, I think euro dollar fits very neatly into thinking about the funding of the twin deficits in the US and that Europe is a current account surplus region. And this idea that those that run on large deficits rely on the kindness of strangers, and whether that level of kindness has been impacted durably by this Middle East conflict. And I personally think it has done, and it might take a little time for it to filter through. But for me, when I look at euro dollar, I'm very focused on whether capital leaves the US and crucially where does it go? And Europe may be one of those places. Later on, love to ask you about Hungary and the florins, and because that feels quite a positive for the euro in particular. Taking out some of the sand out of the gears of the workings of the European Union, that feels important as well. Another point that Brian made was that euro dollar and sterling dollar have pretty much gone back to the levels they were sort of pre the conflict. And the thing that I found fascinating actually is that euro dollar moves seem to be really in line with its short term traditional drivers, not big structural moves in the dollar and high Middle East driven higher oil prices. And our models just fairly simple, but they've been really durable, and they don't need to be recalibrated very often. And they have things like 2-year rate spreads as a key driver. They have European government bond spreads as another one, and they also have relative uh, central bank, government bond market curves as well. And we find ourselves bang in line with those drivers. And so there isn't any hint yet that there has been a structural change in flows to the dollar. And over the next 6 months, that will definitely be my focus. And ultimately, I think that you will see this capital shift in euro dollar move higher through the rest of the year.
Well, kind of feeding into the direction of capital, I guess one of the key things will be US interest rates. And we do finally have Warsh's testimony next week. Brian, do you think this will, force markets to refocus on, interest rate differentials, on coming monetary policy?
Yeah, absolutely. I mean, you think about how this year has gone so far. Had the war in Iran not started, I feel like this might have been the highest profile market event of the entire year. The Warsh testimony, because it's Warsh's first opportunity to weigh in on his view of appropriate policy, both monetary policy, short-term rates, and also long-term on balance sheet policy, and really sort of firm up those expectations around whether or not we should be expecting a big sea change in Fed approach as we head into the second half of the year. You know, Iran has taken a lot of that focus away, and it's forced the market to price away a lot of Warsh related dovish expectations. But the concern, maybe not concerns, but expectations that Warsh will come in with a very dovish posture, a very dovish interpretation of the Fed's dual mandate challenges right now, focused on longer term disinflationary pressures coming from changes in fiscal policy, AI productivity gains, and a continued weak labor market, allowing for wage inflation to not be a major source of upside inflation. Pushing that narrative and pushing back on this idea that changes in temporary inflation spikes due to energy prices or tariffs or something that should push the Fed into a prolonged wait and see stance. I think it's pretty clear that Warsh will lean heavily into that dovish side on monetary policy, near-term monetary policy. What we're not as clear on is the urgency of that dovishness. Because if you look in the media this week, a lot of people, we've had the IMF world meetings this week, and Treasury Secretary Bessent was speaking this week, and he even acknowledged that he understands why the Fed might currently be in a wait and see stance, even if the ultimate direction of travel for rates should be lower. We don't think the president agrees with that. The president clearly wants rates to be lower sooner, and he picked Warsh, I think, purposefully to deliver that as soon as possible. But Warsh could easily come in at his hearing and give one of two possible interpretations. One being a more like where Governor Myron is on, and more where President Trump is, which is we should be lowering rates imminently and quickly and decisively. And a second interpretation would be more where the market is, which is Warsh will be pushing for lower rates, just not at his first couple of meetings because he'll have a difficult time influencing the committee. And so I think this is an important moment, like you said, to reframe those expectations. Now, how much will it move the dollar when so much of the dollar's outlook, the outlook for relative growth, for relative rates, feels like it hinges on the Iran war? Maybe it'll be difficult, I think, for the market to take Warsh being dovish as something that will lead to a big dovish outcome that would weaken the dollar because it sort of would require the Iran war to end, really, to get the committee back on board with a much more dovish interpretation for near-term rates. But I still think that's really important to watch how he addresses his prior stances in terms of the direction of travel for rates, and maybe just as importantly, the urgency. Another factor we'll watch with Warsh next week, which is sort of independent of Warsh, is that his confirmation is unlikely to be influenced by the fact that he's having the hearing, because Senator Tom Tillis, who sits on the banking committee, a key Republican, is still opposing his nomination because of the ongoing probe into current Chair Powell. That's unlikely to go away until the Powell probe is resolved. And so the fact that Warsh is having his confirmation hearing next week shouldn't mean that those issues have been resolved. It is still possible, maybe even likely at this point, that Warsh does not get into the seat before the end of Powell's term in mid-May. Powell has already expressed that he plans on staying at the Fed and staying in his role. And I think, not a lawyer, but current, the as plain interpretation of the Federal Reserve Act would support Powell retaining his position during a period where no one has been confirmed by the Senate to lead the committee. That actually happened as recently as the beginning of Powell's last term. He was renominated. He was not approved for a couple of months between the end of his term, and he was actually named by the board as Fed chair pro tem during that time. So there would be quite a bit of hand wringing potentially around the possibility of Powell being demoted if Warsh's approval is not done by mid-May, and that maybe Powell is replaced by someone else in the committee, say Governor Myron, who is a recent Trump appointee. I don't think the legal system necessarily supports that conclusion. I think it's more likely that Powell simply stays in the seat. And so even if Warsh delivers something very dovish, the market might say his ability to influence the Fed only really starts when he joins the committee. And the further that gets delayed, the further into the long grass, the market might have to push expectations for the return of Fed easing. But I still think this is a really important moment in markets that we shouldn't be underselling, even if it ends up being overshadowed by what's going on in Iran, and maybe rightfully so.
Yeah, interesting though how much kind of political strategy will actually feed into the Fed's outlook in terms of Warsh's timing. Paul, in that context, we've obviously seen a dramatic hawkish repricing for central banks in the aftermath of the Middle East conflict. But there was some signs for the Bank of England that those expectations were at least moderating this week. What was really driving that repricing by rates markets?
Yeah, as you said, there's definitely been quite a significant repricing of the central bank expectations here in the UK. Markets were quick to move from the idea that the Bank of England would be cutting rates this year to hiking rates pretty immediately and fairly aggressively, 100 basis points in total. That always looked a little bit out of line with actual market thinking of market economists. So it felt like it was more to do with a position squeeze, like Brian was saying. Positioning into the crisis was definitely important for financial markets. And so the last couple of weeks has been about pricing back out some of that expected tightening, and it's quickened a little bit this week. And the driver, to answer your question directly, was central bank speakers, Bank of England speakers. We had Daly, the governor. We also had Green, and very much the key takeaway here was that they're in no rush to hike interest rates. They want to see how long the conflict lasts. Obviously, I think a lot of people think the conflict won't last for as long as, say, Russia, Ukraine. The dynamics are different. Brian was talking about the need for a deal on a off ramp, and the severity of the shock also has been less, and it also the cyclical position of the UK economy into this energy price shock is completely different from back in the first energy price shock of 2022, 2023. So markets have repriced, and the key question now is whether they've done enough, and it does feel like they've done enough. If I look at the total pricing between now and the end of the year, it's around 35 basis points. Markets have become far less confident that the Bank of England hikes in April, for example. They're sort of, it's a bit in balance whether they'll hike in June, and the first hike is expected by July. That's a little bit earlier than our base case. When I think about our modal expectation, then a rate hike of 25 basis points at the end of the year, maybe another one at the beginning of next year, looks reasonable to us here at NatWest. The mean, though, is probably a little bit lower than that at 35 basis points, because those two hikes aren't, we think, with 100% probabilities, and that's in line with our overall expectation. The other thing I would say for sterling is that the currency looks a little bit desensitized to changes in rates. The way I normally check 2-year rate spreads against euro sterling, and there's a sort of loose correlation. But unless you think there's going to be trend divergence in policy between the ECB and the Bank of England, I'm not sure it's going to be a major driver. I think the main driver, I think, into the rest of the year will be politics, fiscal policy, and the extent to which the UK economy can hold up. And very much like the dollar, how the twin deficits are funding. We had a little bit of good news this week in terms of GDP numbers for February, but they feel a bit dated. You're running into an energy price shock. Ultimately, it's going to be quite a large hit on growth. So it's going to be a little bit harder for the UK to attract that essential capital that offsets the current account deficit.
Sorry, I was just going to ask you, on UK data, I know we had a number of prints this week. Is there anything that's kind of provided a more timely insight?
Well, not really. I think we'll just have to wait for some of the inflation numbers to come through, and the Bank of England's very much keen to wait for second round effects. My personal view is I think they have to be a little bit careful waiting for second round effects, because once you get those, then the inflation genie is almost out the bottle. And as we've seen in the UK over the last couple of years, it's hard to get that genie back in the bottle. But so we'll be watching inflation data very, very carefully. We'll be looking at the PMIs also in months ahead, because the GDP numbers are a little bit dated. The other indicator that I'm tracking for the UK quite closely for sterling is the inflows into unhedged ETFs for UK equities, and that will give us a sign about whether money is shifting around from the US into other economies. You did ask me earlier about euro dollar, and I did mention potential importance of the Hungarian election result at the weekend, and how it might unlock some of the workings of the European Union in terms of funding to Russia, Ukraine, but also more broadly. But I was just keen to get your sense of what you made of the election, and the impact on the Florence going forward from here.
Yeah, it was an absolute landslide victory for the opposition party, which is pro EU and has campaigned on kind of ending corruption and returning Hungary to the EU mainstream. And they really kind of fought against a system which had really been rigged against them. If you look at the election results, they won 88% of the constituencies. And yes, on the party list vote, it only translated into 47% of those seats. So it certainly hints at some kind of the discrepancy is a little bit untoward in that effect. But we did have, a massive rally in Hungarian assets. And even though this was an expected result, I think, the market wasn't expecting the extent of this victory, that actually TISA won a super majority in parliament, so securing more than 2/3 of those parliamentary seats, which really allows them to actually change the constitution. Markets were also concerned that you would have Hungary's outgoing administration really trying to cling on to power and maybe not accepting the results. So I think the fact that we have a peaceful transition of power also really helped to kind of add tailwinds to the Hungarian forint. But from our point of view, we do think there's further room to run. So we are expecting further gains for the Hungarian currency and also from the bonds. I think there's kind of two big sides to this story. I think, first of all, is EU funding. So, under the previous administration, because they were such EU antagonists, a lot of their EU funding had been frozen. So actually around 33 billion euro in funding had been frozen. And the incoming administration had said it's now a priority for them to unlock it. They do face a relatively tight time frame in terms of unlocking close to 10 billion of that. They have to implement a number of reforms before the end of August this year. But we do think, the practicality will prevail and that the two sides will come to an agreement. The other kind of larger but more longer term economic consequences of this is euro adoption. So the incoming government have campaigned steadily on the promise of adopting the euro. If you look at what's involved in what they call the convergence process for euro adoption, it's effectively a playbook for currency appreciation. So you have to reduce your debt to GDP to 60%, rein in deficits. You have to reduce inflation close to the EU norm, and you also have to construct lower interest rates. So it really adds big tailwinds for the currency and for the bond space that we think will come further into play as soon as we get a euro adoption date. But that is probably all we have got time for this week. Brian and Paul, thank you so much for joining me. If you did like the podcast, please do click like and subscribe so you get the latest episode first. Thanks again.